Hey everyone, and welcome back to the channel. If you've ever looked at the Indian stock market, you've definitely heard the term Nifty 50. It's on every news channel and in every headline. But have you ever wondered what it actually is? Which companies make it up? And why do some of them seem to matter more than others? Well, that's exactly what we're going to decode today. So, what exactly is the Nifty 50? In simple terms, it's the benchmark index for the Indian equity market. Think of it like a report card for India's economy. It tracks the performance of the 50 largest, most well-known, and most actively traded companies listed on the National Stock Exchange of India, or the NSE. Its movement, whether it goes up or down, gives us a snapshot of the overall sentiment and health of the Indian market. It's the benchmark that mutual funds and investment managers use to measure their own performance. So, understanding it is a crucial first step for anyone interested in the Indian market. In this video, we're going to answer two key questions. First, what are the types of companies that make it into the Nifty 50? And second, how is the weightage, or importance, of each stock calculated? So, how does a company get into this exclusive club of 50? The NSE has very specific rules. A company needs to be among the largest, most liquid, and have a good trading history. This ensures that the Nifty 50 truly represents the biggest players in the market. And the index isn't dominated by just one type of business. The Nifty 50 is highly diversified. As you can see, it includes major sectors of our economy. You have financial services, information technology, energy, FMCG, fast-moving consumer goods, and many more. This diversity is what makes the Nifty 50 such a great benchmark. Companies like Reliance Industries, HDFC Bank, Infosys, and Tata Consultancy Services are all part of it. But the list isn't fixed. The NSE reviews the index periodically, usually every 6 months, to ensure it continues to reflect the top companies in the market. Now, let's move on to the second part of our video. How is a stock's importance, or weightage, in the index calculated? The primary factor is something called market capitalization. In the simplest terms, a company's market cap is its total value. It's calculated by multiplying the company's current share price by the total number of shares that have been issued. Think of it this way. Imagine you own a clothing store. The market cap would be the total value of all your inventory and assets. Now imagine the Nifty 50 is like a whole shopping mall. A larger store, say a major department store, contributes more to the mall's overall value and reputation than a small boutique. Similarly, in the Nifty 50, a company with a larger market cap has a bigger pull and a greater influence on the index's overall movement. But here's a little secret you might not know. The Nifty 50 doesn't use the full market cap. It uses something called free float market capitalization. So, what's the difference? A company's total shares are not all available for trading on the market. A large percentage might be held by the founders, the promoters, the government, or other investors who are not actively trading them. Free float is the portion of the company's shares that are actually available for public trading. It excludes all those shares held by promoters and other locked-in investors. The NSE uses free float market cap because it gives a more accurate representation of the market's supply and demand. It reflects the real value of the shares that can be bought and sold, and that's what truly drives market movements. Now that we know about free float market cap, let's put it all together. The calculation is actually quite simple. A stock's weightage in the Nifty 50 is simply its free float market cap as a percentage of the total free float market cap of all 50 companies in the index. This is why you'll see a big move in a heavily weighted stock like Reliance or HDFC Bank have a much larger impact on the Nifty 50's overall value than a similar move in a smaller, lightly weighted stock. The Nifty 50's value is not an average of all 50 stocks, it's a weighted average. So, There you have it. The Nifty 50 is a benchmark index of India's top companies, but its movements are not just an average. They are a reflection of each company's market value, specifically its free float market cap. Understanding this helps you appreciate why certain headlines or corporate announcements have a bigger impact on the overall market. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more content like this.